All right, so here is the review for the week starting on May 8th. Looking at the daily chart, you can see Monday is right here, Friday is right here. We just consolidated this week. The reason why we were consolidating, we are in between two fair value gaps. We have a fair value gap here. This low doesn't touch this high, so that gap in price is a fair value gap. And then this high doesn't touch this low. So we have a fair value gap here and a fair value gap here, and you can see we were just bouncing in between that fair value gap. But I'm going to put some more annotations on the chart and show you a deeper level of how these fair value gaps work. So as you can see, my lines are not to the fair value gaps that I was talking about earlier. This low and this high and this low. It's actually to these fair value gaps here. These fair value gaps are what ICT refers to as balanced price ranges. A very easy way to understand what a balanced price range is a fair value gap that failed, or an inverted fair value gap. So you can see we have a fair value gap here. If this fair value gap was to hold strong, price should have went higher, came into it, went higher, but it failed. When it failed, it created another fair value gap within this fair value gap. So this range is now balanced. Price went up too fast, went down too fast. In other words, offered buy side, offered sell side. So now that is efficient price delivery. It is balanced. The algorithm will remember that. Vice versa for this one. You have a fair value gap this low, doesn't touch this high. Price should go lower, come into it, and go lower if it was to hold. But price trades through it, creating what? Another fair value gap. So this range is balanced the same way this range is balanced. So to begin the week, remember this candle is Monday, I'm focusing on this area in price and this area in price. Now I have two other lines. I have the opening of this candle, which is a bearish order block. We traded higher, traded lower. This candle is the bearish order block, the up close candle before the down move. And then I have this thicker dotted orange line, which is mean threshold. Mean threshold is just the middle of the order block. So if you were to take Fibonacci extension or just do paper math, and from this low to this high, the middle point, or 50%, is 4162.75, which is this dotted orange line. So remember what these levels are when I drop down to the hourly chart, but basically we were just consolidating between the two balanced price ranges. So this is up here, is one balanced price range, and this up here is another balanced price range. The blue dotted line is the order block open. The thicker orange dotted line is mean threshold. Also, I split all my imbalances into quadrants of 4. I guess that didn't make sense. Quadrant's already 4. Forgive me. But anyways, I split it into 25, 50, 75%. Same thing here. You'll see when you drop down to the lower time frame that price is very sensitive to these areas of the imbalance. Remember, an algorithm controls price. So it's not going to just refer to any random level. Or even if you have a brief understanding of what ICT concepts are, it's not just going to go anywhere within the fair value gap. There are very specific levels within the fair value gap that it's going to react off of. Because it's a computer. A computer is told what to do. It doesn't have a mind of its own. It's going to do what it's told. So it's going to refer back to very specific levels. But with all that being said, let's drop down to the hourly chart and see how these daily key levels work intraday to create the weekly range. So looking at the hourly chart, this dotted line separates last week from this week. This is Monday. Each blue dotted vertical line is each day in price. So Monday, Tuesday, Wednesday, Thursday, and then Friday here. As you can see, these daily key levels are very sensitive in price. Look how we consolidate around the order block open. Look how we consolidate around the top of the BPR. Look how the bodies of the candles respect consequent encroachment of this balanced price range. Look how this wick respects 75% of it. Look how the bodies again respect consequent encroachment. We come back down into consequent encroachment. You see the reaction. This candle comes back down into the top of the BPR and we go higher. Looking at it from the other BPR, you see the reaction at consequent encroachment. You see the reaction at the top of the BPR. Look how the bodies don't even go into that range. It just wicks up into it. We go down, we come back up into what? This thick dotted orange line was the threshold of the order block. We hit that, go lower. We hit it again, we go lower. So it's important to have these daily key levels on your chart. It's the most important time frame when it comes to day trading. All of your high probability setups, and I mean all, 100% of them will form around a daily key level. Now, if you want to know which daily key level do you use? Do I use the bottom end of the BPR? Do I use 25%, 50%, or the top? How do I know which one to use? Well, on the smaller time frames, you want to find key levels that line up with the daily key level. So what do I mean by that? If we're looking at consequent encroachment of this BPR, right? Because we see that it hit that. But let's say we see it trading up to it. We don't know where it's going to stop at. Well, we have to find, in this case, an hourly key level that lines up with it. So if we look to the left of the chart, what do we have here? A fair value gap. This low doesn't touch this high. So a fair value gap that lines up with consequent encroachment of the BPR. Well, that's a pretty logical place where price can have a reaction at. And you can see that it does. Looking at this consequent encroachment, we have another fair value gap. Look at the reaction of price. When you know what you're looking for, trading becomes much more simpler. You really just have to find the daily key levels and a hourly or 15-minute key level that lines up with that daily key level. And that is where to look for your high probability setups. Now, just knowing that alone is not enough to enter a trade. You need to see more, which will be taught later on in this channel, but you need to see more. But this is where you find the framework to your trade setups. This is where you look for your trade setups to form. So what does that do? Well, that alleviates a lot of pressure. When you go into the chart, you're not constantly looking for a setup. You know exactly what level it has to hit before you even look for a setup, so you just wait. You put an alert on your chart, you go and do other things. You get a notification to your phone. E-mini S&P has hit, in this case, 4172. Okay, well now, let me go look at the chart because my setup or my model can possibly form now. It makes trading much easier. There's no guessing or gambling to it. Yes, there's always risk, but you're not just going in blind without a game plan. But I also like to use the 15-minute chart. It is my favorite chart for looking for that key level that lines up with the daily. I find that you can refine these hourly key levels much more tighter on the 15-minute chart. So I'm going to drop down to that so I can show you guys what I'm talking about. Let's start with Monday. These gray boxes are the new week opening gaps, which is basically the gap from Friday's closing price to Sunday's opening price. I always note those gaps and I extend them out in my chart because the algorithm will constantly refer to them. It will not forget about them. I like to keep the last 60 trading days worth of new week opening gaps on my chart. So if we start with Monday, you can see we trade below the new week opening gap, come back to another new week opening gap, but in that run, we create what? A fair value gap. Fair value gap within the new week opening gap at what's the daily key level? The order block open. That's a quick scout that you can make. Going from this fair value gap to this order block. That is a quick scout on a 1-minute chart that you can have. Monday, Nothing really too much in the PM session. We had this big spike at 2 o'clock. It was, for the most part, untradeable. It happened within 2 to 3 minutes. Boom, came down to the new week opening gap, and then you see the reaction. We consolidate around the order block open. We start trading lower, come back into the new week opening gap. Another trade opportunity, fair value gap, and the new week opening gap. Come down. Now we consolidate. Why can't you trade this new week opening gap with the fair value gap? Well, time of day. It's 6 o'clock. That's outside of London session, which is from 2 to 5 a.m., and the AM session, which is 8:30 a.m. to, I like to use to 11 a.m., but you can extend it to 12. We consolidate between the new week opening gap and the balanced price range, the top end of that. No real trades on the E-mini S&P, but if you look at NASDAQ, it did form a very nice Tuesday setup that is very similar, but I'll let you look at that for yourself. And Tuesday was pretty much a dud day. Then what do we do on Wednesday? We trade back to the new week opening gap, take lower into what? A fair value gap on the 15-minute chart that lines up with 75%. If we go back to the hourly chart, remember that fair value gap overlapped with consequent encroachment and the 75%. But when you refine it on the 15-minute chart, you can see the fair value gap doesn't include consequent encroachment, so it's likely to come to 75%. Nice trade set up during London, ahead of CPI. Now, what does CPI do? Boom, goes high. If you don't have these levels on your chart, this looks like, oh, the news just made price go higher. It was completely random, but it's not. It stops at a very, very specific level. Consequent encroachment of the daily BPR that lines up with a 15-minute fair value gap and also a new week opening gap. Price is not random at all. And then what happens after that? We trade lower, closing below the new week opening gap and the daily bullish order block open. We trade higher into this fair value gap, close proximity of what? The daily mean threshold. Yeah, the daily order block mean threshold. And then we go lower. Now this one, we go below the new week opening gap into the daily BPR, and we go into this consolidation. Now, when we go to this consolidation, it is now 50-50. It can come back to the new week opening gap, fair value gap, and run out the liquidity. Or it can trade higher, like it does here, and then run lower. Once we hit 50% of the consolidation of the liquidity that you would target, what do I mean by that? If you were taking a short here, targeting this low, what's the consolidation of that low? Well, it's right here. If we hit 50% of that consolidation before you get like another entry, so let's say you entered here, it creates the fair value gap, you want to enter in that fair value gap before it takes out the low, it has to give you that entry before hitting 50% of this consolidation. And it doesn't. It hits 50%, then gives you the entry. You can't trust that entry. Yes, it does go for the liquidity, but look how sloppy it is. Look how much it trades outside of the fair value gap and the new week opening gap before dropping lower. And then after dropping lower, it drops into a very specific level again. We trade higher and to another very specific level. Then we go lower, we trade higher. Look at where the wick hits. The daily order block mean threshold. The bodies stay where? At the order block open and the new week opening gap. Goes lower, another very specific level. And it just happens all week long. Fair value gap, new week opening gap. Goes higher, consolidates around the bullish order block open. Goes lower, takes out this low to go higher. Where? New week opening gap. How much higher can it go? To the order block mean threshold. Goes lower through the new week opening gap. Where does this wick go up to? You see this darker shaded gray box? That's another new week opening gap within the bigger new week opening gap. So we hit consequent encroachment of the big new week opening gap. the top end of the smaller new week opening gap and the daily bearish order block open. Trade through this new week opening gap, fair value gap, go lower to a very specific level. Then we go higher. Where do we close? Within the daily BPR. You see why I like to use the 15-minute chart, because you can refine your levels much more closely with the daily key levels. And that is it for this review. I hope you guys learned something from this, and I will see you guys in the next video.